Hey everyone, welcome back to the channel with me, Fawad Razaqzada, market analyst with StoneX. Today we are breaking down the euro-dollar currency pair ahead of the FOMC rate decision on Wednesday, which could set the tone for the rest of the year in the FX space. So let's jump straight in. It has been a quiet start to the week in the FX markets. That's of course outside of the yen, which continued to slide overnight. But the likes of the pound and the euro, they've been a little bit quiet ahead of the Fed meeting tomorrow, where Powell and Co could set the tone for the rest of the year. The euro-dollar outlook, I think, remains modestly bullish, although in the near term there is a risk of a drop on the back of a potentially hawkish Fed cut. And now that's thanks largely to US data turning a little bit positive in the last couple of weeks. Today, for example, the weekly ADP came in surprisingly higher, which gave the US dollar a little bit of support. The euro has been on a decent run lately, and not just against the US dollar. However, with the greenback selling pausing ahead of the FOMC rate decision, the euro-dollar pair has stalled after climbing from sub 115 handle to around 116.50. However, the downside has been limited for the single currency so far, thanks to at least a few macro reasons, and among those reasons is lower energy prices, thanks mostly to the oversupply from the OPEC Plus keeping pressure on crude oil prices. Meanwhile, gas prices in the US have dropped to the lowest level in nearly 5 years, which is now standing at around $2.90 per gallon on average. Now, the US is an oil exporter, and falling energy prices is usually not a great sign for the dollar. Weaker energy prices have given currencies of energy importing regions like the Eurozone single currency some breathing room. Although not all oil importing currencies have benefited, for example, the Japanese yen and the Indian rupee. Also supporting the euro are ongoing peace talks in the Ukraine-Russia war, which is easing geopolitical pressure, and we've seen this in the form of a recovery in the euro-Swiss currency pair, which is now up for the 4th consecutive week. What's more, even though it's small, we are seeing some mild improvement in Eurozone economic data, which has effectively ended talks of any further near-term interest rate cuts by the ECB. Add in the German fiscal stimulus, which is expected to boost the Eurozone's largest economy in 2026, and suddenly there are not much in the way of negative factors to influence the euro. We are now inside a massive 2-week period for central bank meetings. We have already heard from the Reserve Bank of Australia calling an end to the easing cycle with a widely expected rate hold overnight. Next up is the Bank of Canada's turn to hold policy on Wednesday, where the central bank may hint at the next move being a hike in 2026. Next week, the European Central Bank, Bank of England and the Bank of Japan are among the more important policy meetings to keep an eye on. Of course, the big one is happening this week with the US Federal Reserve, which is expected to trim rates by an additional 25 basis points on Wednesday. But the cut is almost fully priced in, I would say. So the real market mover wouldn't be the cut itself, but more so the Fed's tone about rates outlook in 2026 and beyond. US economic data lately has been mixed, strong in some pockets, soft in others. But whether things will improve or get worse is something no one can predict, of course. That's because, we've had the US government shutdown delaying the release of critical economic data lately. Nevertheless, markets are looking for a softer, a more dovish message from the Fed than we are likely to hear from other major central banks in the next couple of weeks. But here's the risk. If Powell and Co don't validate the 70 to 80 basis points of easing priced in for 2026, then the dollar could easily bounce back, at least momentarily. I say that because the focus then likely to shift to the governance of the Federal Reserve, with current chair Jerome Powell's tenure set to end in May of 2026. Kevin Hassett is the frontrunner to become the Fed's next chair. He's widely seen as a dove, meaning that the pressure on the US interest rates and the dollar could remain well into 2026. So even if we get some short-term dollar strength, the broader trend could still be tilted to the downside for the greenback, keeping the long-term outlook on the euro dollar positive. Now, from a technical perspective, it looks like the euro dollar has already found a bottom around the 115 handle, although momentum is clearly lacking as caution prevails ahead of the central bank meetings and with the dollar finding some mild support at the start of this week. Now, support for the euro dollar comes in at around 116, followed by 115 handle, with the 115.50 being an interim support as well. On the upside, the 116.50 to 116.80 range marks kind of a short-term resistance zone where price has struggled in the last few trading sessions. Break above that, then 117 will be in focus next, with the bigger upside target of being, I think, around 118. But whether we will get to 118 or break above it really depends on the Fed and on the back of the message that we'll get from the Fed Chair Powell. A dovish surprise could open the door for a fresh leg higher, whereas if the Fed is more hawkish, we could potentially see some weakness in the euro dollar in the short-term outlook. But the longer-term outlook is positive, and for that reason, we will maintain a bullish euro dollar forecast. So, could we see a breakout in the euro dollar this week? Well, a lot will depend on the Fed and the message we'll get from Powell. If you found this update helpful, don't forget to like and subscribe. Thanks for watching, and I'll see you in the next one. Take care.